I had no idea Kellogg's was splitting into two different companies, two separate companies later this year. Let's get into the article before we get into the analysis. This article is coming from Entrepreneur. Is Kellogg Company a buy before it splits into two businesses? So Kellogg's company price action is mixed following the Q2 report, but details within the release suggest the company is a buy going into its planned separation. The separation is slated to be completed in Q4 this year and will result in two publicly traded companies. So this might be a sum of the parts is greater than the whole type of play. The first will be WK Kellogg Company, focused on cereal. The second is Kellanova, focused on breakfast and snacking. The opportunity for investors is multifaceted as the split will result in two dividend-paying businesses and a potential multi-expansion for each. Let's explain the multi-expansion. So shares of Kellogg trade roughly 16x earnings, a value for a consumer staple, and a deep value for the two post-split businesses. The cereal company could see its valuation improve to 20x to trade in alignment with Post Holdings, which is a competitor, while Kellanova could see a more substantial expansion based on PepsiCo's 26x valuation. Regardless, the company's growth trajectory and dividend outlook set up for a nice price advance. Also, the stock pays more than 3.5% and is a growing distribution type company for dividends. So what do the analysts think? Well, it's kind of mixed, but they do feel that the bottom is in the stock. The analysts' outlook for Kellogg is mixed, but the bottom is in for the market. The 9 analysts with current ratings have the stock pegged at hold with a price target of about 7% above current price. The most recent activity includes several upgrades and raised price targets that put the stock trading at or above critical resistance. Now, according to the article, they're saying critical resistance is near the $75 level. We're going to look at that a bit more. Let's go to the charts. And we're going to start with the monthly chart. Now, they mentioned the critical area for resistance was $75. We're going to put that on the chart. All right. Now, what you can see is that price did come into a monthly seller's level at $77. Now, Kellogg is in the consumer staples industry, and typically consumer staples are perform better in recessions than discretionaries, technology, etc. So you can see from the monthly chart back in February of last year when things were really cooking in terms of interest rates, Kellogg rose, probably along with all the other consumer staples stocks. But the stock market itself bottomed in October, November, and that marks the high of Kellogg as it hit the monthly sellers level at $77, and it's been in a decline ever since. Again, as the stock market, technology in particular, is up anywhere from 13 to say 17% year to date. All right. However, the analysts think the bottom is in, and possibly based on these wicks here, you had one in March and you had one in June. So you have buyers defending this, say, $64 level. So let's scroll down to the weekly chart. And I must have looked at Kellogg's in the past as I had denoted a monthly buyers level down at the $51 area. Let's put that in, because that would be price selling at a steep discount. So monthly buyers at 51. Now, although this monthly buyers zone is about $13 lower, that would be a big move for a company like Kellogg. All right, let me scroll to OK. Now, the reason why I squeezed up the chart, I do want to recognize this resistance support band down at $56. All right. Now let's scroll down to the weekly chart. And you can see, let's map it out. Price was making higher highs and higher lows. And then things shifted right here. Made its first lower low, lower high. Lower low, lower high. And if you mark off the trajectory, you're potentially looking at something like this. Although the analysts say the bottom is in. All right, let's go to the daily chart. Now you can see price is below all the moving averages on the daily chart, in particular the 200-day moving average and the 50-day moving average that's in red. So that's bearish. Again, you do have defenders at the 64.50 level. Now I'm going to look at current price, and I'm just going to go to the left. And I don't really see any levels of interest from a volume standpoint. So let's do this. If the analyst is right, then $64 is the bottom. However, don't try to catch a falling knife. I want to see price make a higher high and a higher low before considering going long Kellogg's, and you should do the same. If you do options, well, you can probably do an iron condor, debit spreads for to earn some credit. Yeah, this is a no touch. I think the you'll see a bounce, you know, because the broader markets are due for a correction. But we're getting close to the fall time. Typically, August, September, October are rough months for the stock market, but then we have a strong run into the end of the year. So I anticipate Kellogg's bouncing, but it is not a buy, and it's not a buy before the split. It's not worth it. There are better opportunities to put your capital to work. Thanks for watching. Subscribe. Please like the video.